Hi everybody, my name is Nik Tsoukalis. I'm the CEO and President of Key Credit Repair. Today we're going to be doing a brief tutorial. I'm going to be taking you through an action plan that'll essentially outline how you can repair your credit so you can eventually buy that home of your dreams and more importantly stop renting and paying off your landlord's mortgage. Okay? First thing I'm going to ask you to do in this process is to get out a pen and a piece of paper. And I'm going to have you jot down a few notes, primarily what you're seeing here on this screen, on this roadmap for success that I'm going to take you for. So we're going to fill this in on our screen here, and I'll probably be sending you a copy of this recording. But if you can jot this down, I think it will make learning this process a lot quicker and more efficient. Okay? So you're going to see the first step in this action plan is going to be some goal setting. Okay. Obviously, if you're on this webinar right now, one of your main goals is not being a renter anymore. You're looking to buy a home, so you're probably working very hard. You're getting up early every day. You're getting the kids to school. You're sitting in a cold car, and you're wondering, why you're working this hard and having to pay off someone else's mortgage. You're a renter at this point. Okay. In the United States and most of the major metropolitan areas, the cost of renting versus owning that comparable home or that same home is more than 25%. So it's going to be more than 25% more expensive to rent the comparable home that you're living in. That's a lot of money to be throwing away. Never mind the different tax benefits and just the flexibility of owning your own home and really having something to pass down from one generation to another. So we're going to take a few seconds here and just simply jot down these goals. Okay. So in your case, it's probably going to be to purchase a home. Oh, excuse my spelling mistake there. Also, if you haven't already, I'm going to have you jot down these specific categories. Okay. And they're going to make sense in a few minutes. So if you have that pen and piece of paper handy, in the top of your sheet, I want you to jot down goals. Okay. Give yourself a little space. And right below that, you're going to jot down the phrase cleanup. Give yourself a little bit more space and jot down BuildUp. And give yourself a little bit more space and jot down the word or phrase pay up. And I promise these 3 ups sound a little funny right now, but they're going to make a lot of sense and they're really going to simplify your approach in improving and repairing your credit score. Okay? So first section we have is goals. Okay, what are your goals? You're obviously purchasing a home. Okay, but we need to break that down in terms of credit score. Keep this in mind. Regardless of where we think our credit is right now and how credible we think we are, banks and lenders, the only thing they have to go off of right now is that 3-digit score that they're going to get through a credit monitoring company like FICO. Okay, so the first thing I would suggest we do is we get you a copy of your credit report. Okay, if you're already monitoring your credit, that's great. You might actually be very aware of what your credit scores are. If not, I'm going to just show you a few examples of some websites where you can access your credit scores. I'll give you an idea of some different costs out there and why you should probably look into certain credit reports over others. Now, the first website I'm going to show you, which is probably one of the most popular ones out there, is called Credit Karma, a site we use a lot and one of the sites that many of our clients use right now. Okay, Credit Karma is going to give you a free Vantage score, which is an educational purposes only score. Gives you a really nice handle of where the credit is. Okay, it's not the exact same score that a bank or lender is using, but for the purpose of just educational or for educational purposes, it's definitely a pretty solid score. Okay. Also keep in mind that this report is free of charge. Okay, they're not charging you anything, which is pretty nice. It saves you quite a few bucks here. Okay, but there's a reason for that. There are going to be quite a few marketing offers when you log into these websites. They're going to be soliciting you for credit cards and things along those lines. Okay, so keep that in mind. Also keep in mind that the Credit Karma report is only going to give you TransUnion and Equifax data. Okay, that could be a problem because keep in mind when it comes to the process of buying a home, banks and lenders are going to want to see Equifax, TransUnion, as well as Experian. Okay, so that's super important. Okay, if you're just trying to gauge where your credit is right now or to get access to some of the data, I guess it's okay, but definitely not going to be the most concrete credit report out there. Another really good site that we like is Privacy Guard. Okay, Privacy Guard for a monthly membership, somewhere in the, I think, $29 range, is going to give you access to all 3 credit reports and 3 credit scores. They're not FICO scores, but they are relatively close, and the data is very clear and very easy to read. We're big fans of Privacy Guard, and I've sent probably a few thousand clients to the Privacy Guard website over the years to monitor their credit there. Okay, they do a great job. They have pretty good customer support too. So if there's an issue accessing some of the data, it's pretty easy to give them a call and have them fix something. Okay. Also keep in mind, and you're going to see this in very, very small letters here, credit score is developed by Credit Expert. Okay, so that Credit Expert score is a credit score, but similar to Vantage Score, which is what Credit Karma is using, it's for educational purposes only. It's going to be very similar to what banks and lenders see, but it's not exactly what they're going to see. So keep that in mind. Okay. Last but not least, we have MyFICO. Okay, this is definitely my favorite for those that are trying to become homeowners, and there's a specific reason why. Banks and lenders, mortgage companies specifically, when they're underwriting a home loan and they're doing that pre-approval, they're only getting credit scores from MyFICO. Okay, and typically they're getting the specific credit scoring formula that's been around forever and ever. It's called FICO 4, and it's the scoring formula used for mortgage banking. Okay, there are different, more updated versions of the FICO score. You can actually see here in some small letters like FICO score 8 and FICO score 9. These are different looser scores, looser versions of the credit score. Typically, they run higher than what a bank or lender is going to see, and they make you look good. But keep in mind, banks and lenders aren't using that credit score. So keep that in mind. Also, it's a pretty expensive credit report. FICO knows that this is the only place you can get the exact same data that a bank and lender is using, and as a result, they charge appropriately for it. A one-time credit report with all 3 credit scores in all 3 credit agencies is $59.85. Not a little money, but for those of you that are really serious about buying a home, I would suggest you spend the money. It's worth the investment because, again, you're going to get that exact data that a bank and lender is going to see. When you walk into that mortgage company and they tell you, hey, I have a 640, you have a 640 credit score, you already knew that. Okay, you're not going to walk in there thinking you had a 670 credit score because you checked your credit on Credit Karma, or maybe even lower. Maybe the score is saying 620 and you think you couldn't get approved because you went through one of these other websites. But in fact, that the FICO score would allow you to get approved at this point. So keep that in mind. Now, obviously, we don't have your specific credit report up, but if you want to pause this and go ahead and head over to Privacy Guard or MyFICO and Credit Karma and get yourself a free credit report and maybe follow along here and take notes on your specific credit report, feel free to do so. I think it'd actually be a good idea. Hit pause right now, put me on hold, and move on to one of these websites. Again, we have Credit Karma, we have Privacy Guard, and we have myfico.com. Okay. Now, let's say you do have that credit report up. You've gone to myfico.com. You've pulled up a 3-in-1 credit report. It's going to have all the data from TransUnion, Experian, and Equifax, including all 3 credit scores. And you want to start building out your action plan. Okay. Now, right under goals, you basically want to jot down each of the credit scores. Okay. So let's say, for example, we had a 595 for Experian. Then for Equifax, we had a 575. And then for TransUnion, we had a 605. Okay. Well, a bank or a lender, when you go in for a mortgage, keep in mind, okay, they're not going to average out these credit scores. They're not going to pick the highest or the lowest. What they're going to do in this case is they're going to pick the median credit score when you go in for your approval. So in this case, if you were to stack up these credit scores from largest to smallest, okay, in terms of value, you're going to find that the median credit score in your case is going to be that 595 credit score. Okay, so keep that in mind. Okay, so in your case right now, if this was your credit report, we'd be at a 595. Okay, now let's create some goals here. Okay, based around your let's create some credit score goals based around the purpose of this, which is purchasing a home. Let's see what the deficits are, and let's see if we can make up the deficits with a really concrete and clear action plan. Okay. So next to goals, you want to jot down these 3 numbers here. Okay, and I'm going to explain what they mean. You're going to want to jot down 640, 680, and then 740. And let me explain what these mean. So 640 really is what they call a bankable score. So let's say you went to a mortgage company and you tried to apply for a mortgage. You're going to find that in today's market, in 2017, many of the banks and lenders that are out there are starting to offer what they call an FHA loan. It's a loan that's insured by the Federal Housing Administration. It allows you to start accessing mortgage financing with far less than superior credit scores. And the reason for that is the Federal Housing Administration is going to allow you to pay an insurance premium above and beyond the actual mortgage payment they require. And that insurance premium is going to go into a pool with the federal government, and that money is going to be used to essentially insure all these loans, millions of loans across the United States for these banks and lenders that wouldn't necessarily want to take the risk on their own. So let's keep 640 as goal number one for you. Okay. Not a great score, but we're going to call it a bankable score. We know you are in the door. You're starting to get things financing. You're starting to get things financed, and you're getting approved for things. Maybe at not the best rates that you'd like. Maybe without maybe you're not getting the best payment options, the best down payment options, but at least you're in the door at this point, and that says a lot. Okay, we have a lot of clients that get to this bankable position. They've never been there in their entire life. And this alone is a game changer. And sometimes, even if they're not at the point where they're going to have a 740 yet, getting to that bankable position and being able to move into a house they own, it's going to change their entire life. Okay, and I hope that's going to be you soon. Okay, but we want to shoot past that point. Goal number two is going to be 680. Okay, not a great score. Okay, but what it is the national average. So most websites you're going to check out right now, you're going to see the national average listed somewhere around the 680 mark. Not perfection, but there's something said for being at and above average. Okay. Also, what the 680 is going to allow you to do is access conventional financing. And conventional financing is when you're able to finance a home without having to take an FHA insurance premium on top of your mortgage. It keeps the loans cheaper, gives you more mortgage options. It allows you to go through conventional financing that doesn't necessarily require additional underwriting from the Federal Housing Administration, which is better financing. Always keep in mind, the higher the credit score, the lower the interest rate, the more options you're going to have. You're considered a lower risk with a higher credit score. Now, goal number three is where we really start to have some fun. Okay. Goal number three is going to be the 740 number. 740 is a big, big number. It's very important. Okay. It represents a few things. Number one, in the eyes of most banks and lenders, is considered top tier credit. Okay. When you have a 740 and above and you start walking into these different banks and lending institutions, you're calling the shots. They're fighting for your business. Okay, you have this perceived risk that's just far greater, or excuse me, far less than if you're at a 680 or even a 740. Okay, and banks want to fight for that business. Okay, so they're going to consider you an A+ borrower. In addition to that, you're going to be able to access things like jumbo loans. If you're in some of the major markets in the United States, like Boston, New York, Los Angeles, San Diego, many areas in Florida, you're going to find that the average loan sizes, they're climbing rapidly. Okay, the home buying process is becoming more competitive, and it's making home prices go up. Okay, also with interest rates being so low, some of the bigger loans are becoming less expensive, and it's creating the market, or it's causing the market to surge upwards in terms of price, not necessarily in payment, but definitely pricing. As a result, jumbo loans are going to be something pretty much a necessity in most of the major markets in the United States. In addition to that, you're going to have lower interest rates. Okay. Again, the higher the credit score, the lower the perceived risk of the bank. And as a result, you're going to access lower interest rates. Now, keep in mind, when you're buying a house, you're financing that over 30 years. That's a long, long time. Even a quarter of a percentage or an eighth of a percentage can be thousands upon thousands of dollars over the course of that 30 years. And maybe it's not a lot of money that you would maybe necessarily notice, from one month to the other. But keep in mind that money could be placed in a better place, or it could be It could be sent to a charity you care about. It could be reinvested into your retirement account. It could be reinvested into more real estate. So let's not start giving away our paycheck to banks and lenders because of a low credit score. And that's why even though a lot of my clients can get approved at 640 and they'd be happy at 640, I always remind them that 740 is such an important number. Okay. The higher the credit score, the more disposable income when you do buy the house, the more money that you have that you can free up to put towards other things, really that are going to build up your wealth versus just silly interest. Okay. Alrighty. Okay, we've established the fact that we want to purchase a home. We have established the fact that we want the highest score possible and why. Now, the next question, and by the way, some of these things are fairly obvious, so I apologize if you're already very well aware of that 740 top tier credit score. Um, but how do we get there now? So we're at a 595 credit score. We need a good 245 points to get there, to get to that 740. Like, how do we actually achieve higher credit scores? Well, really, you want to focus on three categories, okay, or something I call the three ups. So if you haven't already, you definitely want to jot down these three things. You have cleanup, build up, and pay up. Okay, leave a little space for yourself on the sheet of paper that you're using because you're going to jot down some pretty simple notes. So the first step we're going to focus on is something called cleanup. Okay, you'll find some interesting statistics out there that over 90% of credit reports have derogatory marks on them. Things like late payments, collections, charge-offs, different negative marks, a lot of them being unverifiable, inaccurate, obsolete, things that have expired, past the statutes of limitations, you name it. The level of inaccuracy on many of these credit reports, it's really far out there. I've heard statistics that more than a quarter of these credit reports have inaccuracies that are severe enough to cause a decline in the loan. Okay, never mind just getting a higher interest rate. Okay, so the first thing that we really focus on here at Key Credit Repairs is cleanup. You know, how many negative records do we have? Are they verified? Are they accurate? Have they ever been contested? And how can we reduce the number of negative marks that come up on a credit report to ensure that when we go to the credit agencies, we have the most clear and accurate credit report and we have the highest credit score possible as a result. Okay, so in terms of cleanup, quite simply, we're going to go through our credit report at this point. And what you would do is you would go through your credit report at this point and simply jot down the number of negative marks that you have against your credit report. Okay. Now, some of these could be previous negative marks or things that maybe have been paid off, but you're unsure if that record should be there or not. You're probably wondering, why does it even matter if it's in the past? Well, here's why. Okay. This is a little chart from FICO directly, which basically explains, what makes up your credit score. You're going to find that 35% of your credit score is made up of payment history. So although maybe your debt profile looks really, really good and healthy right now, you may have a lot of previous derogatory marks that have accumulated over the years that shouldn't be there, okay, that are weighing down the greatest portion or the greatest piece of the pie here in this FICO score chart. So 35% of your credit score is being affected by those previous negative marks, okay? So let's say in your case, let's jot down these notes. We had a total of 5 negative marks on the Equifax. Those same 5 negative marks on the Experian, and those same 5 negative marks on the TransUnion credit report. Of course, keep in mind they're probably those same 5 negative marks. Okay, maybe these are old collections that have been paid off. Maybe they're previous late payments. Maybe they're just things that straight up, you look at them and wonder whose are these. Okay, it's a case of mistaken identity or name mix-up, whatever the case could be. Either way, these 5 negative marks that are hitting all 3 of the bureaus are affecting, again, this 35% of what makes up your FICO score. It's the single greatest thing that hurts or benefits your credit score. Okay, so what do? Well, we need to reduce the number of negative records that appear. So what we're going to be doing is we're going to be working to reduce the 15 negative items that appear on the credit report. Okay, or we're looking to reduce this number. Okay, so keep that in mind. And we're going to make this a little bigger for you, just so it's a little easier to read. How do we do that? Well, let me give you a quick little tutorial on how to remove a negative record or how to contest something. Okay, and I'll actually jot it down here. So one way you can remove a negative mark from your credit report is by requesting that the credit agencies remove it or contesting it. Okay, so let's say, for example, you were to send a dispute letter off to one of the credit agencies, like Equifax. Okay, When Equifax receives that dispute letter, they're going to be required to open up an investigation regarding that account. With that investigation, they're going to go ahead and forward that dispute to the creditor that has placed that negative mark against your credit report. So let's say there was a questionable collection on the credit report. They're going to forward to that debt collector a copy of that dispute, notifying them that you've contested this negative mark. Upon receipt of that dispute, that creditor will then have a 30-day window to respond back to the credit agencies to oppose our request for removing that negative mark. So they'll have 30 days per something called FACRA, or the Fair Credit Reporting Act. So they'll have a 30-day window to get back to the credit agency to oppose our request for removal. Okay. I'll give you one example, one really simple example to conceptualize of how something can be removed. Okay. And that's based on non-response. So let's say, for example, that credit agency at that point, or that debt collector, excuse me, hadn't responded in that 30 days. Okay, 30 days goes by, and they've simply done nothing. Okay, maybe it's a debt collector that's no longer in business. Maybe it's an unverifiable record they can't document. There are a million maybes. Maybe it's something where you just pass the statute of limitations. Okay, and they simply can't respond because they have no justifiable reason for keeping that negative mark there. Well, on day 31, if the credit agencies haven't received a response, they will then go ahead and delete that negative mark. That's considered inaccurate or unverifiable data, and it doesn't belong on your credit report or really anybody's. Okay. As a result, the credit agency, they will remove that negative mark. They will then mail to you a confirmation confirming to you that the record has been removed. Okay. And obviously, considering the fact that 35% of the credit score is based on payment history, with that deletion, you should see an immediate increase to the credit score. Depending on how recent that negative mark is, that credit score should go up. Okay. Now, what you want to do at this point is you want to challenge all of the negative marks that appear on the credit report. Not everything is going to get removed, okay? But you want to make sure if anything is questionable, if something is not quite right, if you find a variation between how Equifax and Experian is reporting the same record, well, something is off, okay? And everything on the credit report needs to be 100% accurate and verifiable. So my suggestion is to take this process and do it across each of those negative marks across all three of the credit agencies, okay? And also be persistent. If you get back the first 15 set of responses, because technically you're going to be sending out 15 of these, and you see 5 of the items removed from one bureau and maybe the other 5 not removed from the other, that you consider inaccurate, keep in mind you can do it again, okay? You want to be persistent when it comes to having fair and accurate credit. You want to make sure you're writing rebuttal letters, and you want to make sure you are persistent. The process of having an accurate credit report can take months and months and months. It shouldn't. I'd love to think it was a quick couple of week or couple day process, but it's not. We have many of our clients we're working with over the course of months to properly repair their credit and get them prepared to buy a home. So be patient, be persistent, and be tough. Now, the second part of the credit repair process, or up number 2, is going to be BuildUp. Now, this is really important. What we typically find is a lot of credit repair companies out there put a major emphasis on the credit cleanup, and rightfully so. Nobody wants garbage and inaccuracies on the credit report, but there's a lot more that goes into the actual credit score. And ultimately, what we care about is having a credit score that's going to allow us to get approved for things. Okay, BuildUp is important. Let's say you went to a bank or lender and you had nothing on your credit report. You had a blank slate. Okay, everything was squeaky clean, but there was no positive information. Okay, number one, you're probably not going to have a credit score. And number 2, the bank and lender is going to deny you based on just lack of credit. Okay, what you want to do is under BuildUp in your action plan, you want to jot down these 3 numbers, 1, 2, and 3. And the reason for that is most banks and lenders want to see that you have a minimum of 3 active, healthy trade lines on the credit report. Okay, so think to yourself or look at your credit report. What open credit cards do I have? Do I have a couple of them? Do I have a car loan? Do I have a student loan? Do I have a mix of all of these? Do I have more than 3? If we don't have 3 active trade lines, it's something we want to work on. But take a second at this point, maybe put me on pause again and look through your credit report and confirm how many positive accounts do I have? Okay, let's say in this scenario, you had an open car loan. Well, check. We like that. That's fantastic. That's going to be number one. Let's say in addition to that, you had one credit card with Citi. All right, check number two. We're looking good. But let's say that was it. We had no other active open accounts. Okay. Well, part of our action plan at that point is going to be to open up a little credit. Okay. So in this case, you'll see in this action plan, I've actually added a little note here that said open one secured credit card. A secured credit card is just like any other credit card, with the exception of the fact that with a secured credit card, you have the ability to put up a security deposit so the bank or lender can overlook the fact that your credit scores are a little lower than you'd like. Okay. The perceived risk, if you have a 595 credit score, is fairly high. They're not going to want to approve you. So at that point, putting up a small security deposit is going to offset their risk, and they're going to be more likely to approve you. Okay. Also, I've included a nice little website here called bankrate.com. They should have a section on secured credit cards that's really easy to use and access. You can access a bunch of different credit card companies there, and it would be a wonderful little tool so you can start reestablishing your credit, meeting the demands of banks and lenders, and getting to that magic number 3 that a mortgage company is going to want to see. Always keep in mind, it's always about the magic 3. Okay? Now we're going to move on to the third section of our action plan, which is going to be called Pay Up. This is a section everybody dreads just because the way it sounds pretty bad, Pay Up. But I promise it's a lot easier than you'd think. It's going to be one of the sources of one of the greatest credit score boosts you can get. And it can be pretty drastic how quickly we increase the credit scores in this specific section. All right, so the first section under Pay Up is going to be called Utilization Rate. And this is a source of typically a quick credit score boost for many of our clients. Okay, and I'll explain why. First, I'll explain what it is, then I'll tell you why we can boost the credit score pretty quickly if we understand how this utilization rate or utilization ratios are actually calculated. Okay. Now, if we go back to how the credit score is calculated, you're going to find that 30% of the credit score is based on amounts owed. Specifically, the amount you owe on revolving credit card balances divided by the actual credit limit. Okay, that's 30%, almost a third. It's the second biggest thing that affects the credit score. Okay, now let's say you went through your credit report and found that your Citi card, okay, had a balance of $460. It's not a lot of money. In the grand scheme of things, to think that the majority of households in the United States owe well over $10,000 in credit card debt, well, 460 is not a lot. It's a starter credit card at this point, and the balance is very low. You could be doing pretty well financially as well, so you're thinking, no big deal, okay? But banks and lenders, they care more about how you're utilizing the cards versus how much you actually owe. Okay, in this case, that $460 balance you may have on your Citi card, okay, is on a credit card that has a limit of $500. Okay, probably still thinking, hey, whoop-de-doo, who cares? Well, the scoring formula is going to take a look at that and immediately red flag the file. Okay, and the reason for that is something called the utilization rate. The utilization rate on that credit card is going to be 92%, which is extremely excessive, okay, in their eyes. Again, they don't care how much you owe. They care how much you owe in proportion to the credit limit. Our advice, and one thing we tell every single client, is pay down all credit cards below 10% of the credit limit. Okay, so in this case, if we had a $500 credit limit, we want to get that balance down below $50. Okay. If you want to keep the balance at zero, feel free to do so. Even though you're not necessarily making a payment on that card, if you're carrying a zero balance, it will still default to an on-time payment when it's zero. So you will still be getting the benefits out of the 35% of the credit score that's based on payment history with that on-time payment, although you're not having to necessarily send in a check each month. This is a quick source of fast points. Okay, we have some clients. This alone is. We have some clients where this alone is something that's keeping them away from that 640 mark. Okay, and not to say the 595 to 640. That 45 points is gonna necessarily give them the best interest rate. But again, it's nice to know you're bankable. And if it's just a matter of paying down a small credit card, then so be it. Okay. Right below that, you're going to see past dues. Okay, what you find is sometimes we have a really pretty clean credit report. We don't have a lot of derogatory marks that need to come off. We have a good source of positive trade lines. We have the 3, maybe even more. They've been on time for a long, long time. But what we find is that the credit score is abnormally low, sometimes even lower than this 595. Okay, and the reason for that, typically the culprit is a past due account or a recent past due. So let's say you've been on time forever and ever on everything, and your payment history is absolutely stellar. Okay, your utilization rate looks good. Length of history is nice and long, so that part of the credit score looks good. You have a good mix of active installment, revolving, maybe even real estate credit at this point, but the credit score is in the 500s, and you can't figure it out. Typically, what you want to do at this point is look for past due accounts. Did something just fall behind? Okay. Do you have this one perfect trade line that for some reason you just maybe missed the payment? It's currently behind. You haven't brought it up to date where it's going to reflect just a previous 30-day late. It's currently in that negative status. When something like that happens, it's a red alert for the credit agencies to really tank the credit score. Okay. It might not necessarily be a case of you having some financial issue. It could just be a mistake. But the way the scoring formula works, it's going to consider that a red alert. There's no fire in the building, but they're going to pull that fire alarm and everyone's going to vacate and run scared. And it's the same thing with that credit score. The exact same thing is happening. Okay. So what I would say is if you have any past dues, the first thing you should do is quickly bring those current if you have the means to do so. So you want to bring those accounts or account current as quickly as possible. Okay, we've seen 750 credit scores drop to the 6s and the 5s just from this. Okay, now bringing the account current isn't necessarily going to remedy the late payment mark that's being created, but it's going to remedy the past due, and that alone could be 50% of those points you've lost regained very quickly within the next 30 to 45 days. Now, last but not least, we have collections and charge-offs, aka bad debts. Now, keep in mind, when most people pull up their credit report, this is the first thing they attack. This is the first thing they focus on. You notice I've left it for last. There's a specific reason behind this. Many of the collections and charge-offs that we've found on our clients' credit reports over the years really are garbage. We challenge companies to validate a debt, and they simply can't produce anything. Or a debt was owed at one point, but it's past the statutes of limitations. So we're not going to start handing people our hard-earned money that really shouldn't get paid something. Okay, something that is outside of the federal statutes of limitations or maybe the state statutes of limitations. All right, so under collections and charge-offs, we want to take a specific strategy to avoid really paying for things we shouldn't. We want to do the right thing, and I'm sure you have all the good intentions in the world to get rid of the debt, but you want to do it in a strategic fashion so you don't end up paying off debt collectors that really you shouldn't be paying. Companies that are scrupulous, unverifiable debt, items that are past the statutes of limitations, maybe duplicate entries. What I'm going to suggest is under the collections and charge-offs category, I want you to make a note that basically says 90 days. Okay, you really want to have a 90-day lockout period before you really start challenging, or excuse me, before you really start paying off those collections and charge-offs. The 90 days really gives you at least 2 cycles of challenges and disputes with the credit agencies, as well as directly through the creditors if you're using a debt validation process as well. Okay. Once that 90 days is up and you see that there's been a reduction in the number of negative marks that you have, and you do have some collections and charge-offs that are left over, then you can start getting into settlement offers. So let's say that 90 days is up and you find that you have maybe 2 or 3 open collections that have been verified by the credit agencies. They've been properly verified by the creditors as well. And you want to start paying off those accounts. You want to take a specific strategy so you're really not overpaying for those debts. Keep in mind that most debt collectors, they're paying something like 10 cents on the dollar to buy that debt from the original creditor. So you just calling and paying off that $500 collection at face value, plus the interest and fees and other different costs that they're putting on top of that, you paying back that $500 debt at $700 or $800, you're just lining someone's pocket. Imagine your $500 collection was bought by a debt collector for $50, and you went ahead and paid them back $500 plus interest plus fees, plus a bunch of other garbage, and you end up paying for what is essentially a $50 debt at that point. You end up paying back $700 or $800. That's something you really want to avoid. And the way to do that really is a proper settlement offer. Okay. A settlement offer is a pretty simple concept. It's typically a letter you put together, even a phone call you make, where you're letting the creditor know or debt collector know you're willing to pay off the debt, but you want to reduce that balance. Maybe you don't agree with the balance, maybe you don't agree with the interest and fees, but either way, you're asking for a reduced cost at that point. If you have a $500 debt, there really is no reason why you can't cut that balance in half. Now, the trick with settlement offers really is speed. Keep that in mind. Okay. When you're reaching out to a creditor, realize that those debt collectors, they typically have a sales quota, just like any other business or organization. So when you're reaching out to them and you have the money handy to make that settlement quickly, they're usually going to be more willing to deal with you. And the reason for that, they have units quotas. Okay. They also have volume quota, which is the dollar amount they're collecting. So your $250 or $200 or even $100 could very well get to that debt collector over that quota. So my suggestion is, with the collections and charge-offs, give yourself a 90-day lockout period. So God forbid you're not paying back a debt collector or a collection agency a bunch of money that you shouldn't be. Okay. Once that 90 days is up, then you want to start working on settlement offers. Okay. Also, another thing that you really want to focus on is something called a paid for deletion option. Okay. And you can make a note of this too. In many cases, when you reach out to that creditor, okay, and you negotiate that settlement, you can ask for what they call a paid for deletion. And a paid for deletion is fairly simple. You're agreeing to pay off that debt really for the purpose of getting the record removed. And why do we want to do that? Well, let's keep in mind, if you pay off that debt, what you're affecting is the 35% of your credit score that's based on, or excuse me, when you're paying off that debt, you're affecting the 30% of the credit score that's based on amounts owed, correct? So that immediately is going to have an impact on the credit score in a really positive way. But that still doesn't necessarily remedy the fact that the collection mark appears on the credit report, okay? But let's say you can go ahead and have them agree to delete the record with a payoff, okay? You're going to find yourself really grabbing points in two different spots. You're grabbing points from amounts owed, okay? And you're also grabbing points from payment history. That's 65%, collectively 65% of what makes up the credit score. So the impact could be very, very dramatic if you approach it in that fashion, okay? So keep that in mind. Now, just to quickly do a recap, the first section of your action plan at this point really should be goal setting. What are we shooting for in terms of an overall goal? What are the credit scores that we need to get there? And always keep in mind that you want to shoot very, very high. If you fail to get to that 740 and you land at 680, well, you're still well above that 640, okay? And you're going to get a pretty good deal on a pretty inexpensive mortgage, and you're going to avoid paying back a mortgage insurance premium to the Federal Housing Administration, okay? The second category was cleanup. You want to drastically reduce the number of inaccurate, negative, and unverifiable marks that appear on the credit report so we can pump up that 35% of the credit score that's based on payment history. The next thing is BuildUp. Do we have enough active positive accounts? If we don't have at least 3, we want to get at least something. Okay, put that into your action plan. If you don't have those 3, in this case, the scenario I gave you, I had asked the client to open up one secured credit card. Okay, and a good resource for that would be bankrate.com. And last but not least, we have PayUp. We want to keep an ultra low conservative utilization rate. 0 is the best number, but if you can't maintain a 0, let's keep it below 10% of the credit limit. If we have a recent past due and nothing else, quickly bring that current. We can deal with the negative mark later on by petitioning the credit agencies or the creditors through something called a goodwill intervention. And last but not least, we have collections and charge-offs. Okay. Remember, we want to keep a 90-day lockout, okay, before we start paying off any old collections and charge-offs, especially if something is fairly questionable. Okay. We want to challenge those records. We want validation of everything. We have confirmation where we signed for something. We want proof that the date of last activity is accurate, which triggers your statute's limitations. We want proof of everything. Okay. If it can't be proven, We're going to go ahead and request that the credit agencies remove it. It's a violation of the Fair Credit Reporting Act. It's inaccurate negative reporting. And then beyond that, it's a violation of something called FDCPA, which is your Fair Debt Collections Practices Act. Okay. And those are the basic laws and bylaws that have to do with the collection of debt. If something does come back verifiable, remember we want to shoot for a settlement offer. Okay. If a creditor has bought a debt for 10 cents on the dollar, we don't want to go give them 110 cents on the dollar. That's just lining some debt collectors' pockets for no reason after something's been mostly charged off. And also in our settlement, we always want to shoot for a paid for deletion offer. It's part of the negotiation tactics. It can make or break you in certain cases, and sometimes, if you're going to grab a quick 50 points from paying something or settling something, it could probably grab you an additional 50 points, and it's just a matter of how it was negotiated. Ladies and gentlemen, my name is Nik Tsoukalis. I'm the owner of Key Credit Repair. I really, really appreciate you attending this video. This is the same roadmap to success we've used for over 30,000 successful clients here at our company. We're a one-on-one company. We have 10 consultants here that handle the one-on-one consultations. We don't sign up our clients online. We don't have an online enrollment form with our company. Everyone deserves a chance to get a clear and accurate and concrete action plan. If after the end of this video you find that maybe this is a little too much for you to take in, don't feel like you need to go it alone. Okay, you can request a free consultation from our company. Either myself or someone from my team will reach out to you. I'll even leave you guys with a link below where you can book a specific time, maybe book a half an hour long block where you can schedule it any time between 9 a.m. and 9 p.m. Monday through Friday. And we also have people on staff on Saturday between 9 a.m. and 5 p.m. And what we'll do is we'll go through your credit report. If you don't have one, we can go ahead and request one for you, either through MyFICO, through a free credit source like Credit Karma. We can go through Privacy Guard. If you already monitor your credit or have a credit report from a bank or lender, we're happy to review that with you. We'll put together one of these custom action plans specific to you. We'll go into some additional detail as well and talk about each of the specific trade lines and how we would approach attacking and removing those negative marks. We'd give you a timeline as to how long it could probably take for you to get to that 640, 680, or even that 740 mark. Okay, and how realistic it's going to be. And then at that point, if you find that the services would make sense for you and you'd like to hire us to do some of the heavy lifting, we'd extend out an offer and give you a price quote. Also keep in mind our consultations are 100% free of charge. There's never a commitment. We're not a pushy company. We want you to get plenty of good information up front. Also, aside from this specific video you're watching, when we do your consultation and we have you take down these notes again custom to your credit report, we want to make sure that you understand the process well enough that you could turn around and actually help a friend, a cousin, a family member with their own credit. Okay, and it's something we've been something we've been very proud of over the years. The majority of our clients have become advocates for the credit repair process. Okay, they've gone out and helped their communities, they've helped friends, they've helped families, inexpensively, free of charge, showing them how to control and leverage their credit report to build wealth in their life. Okay. Again, this is Nik Tsoukalis. Thank you for checking out Key Credit Repair. Thank you for watching our video. And again, if you're interested in setting up that free consultation and getting that specific action plan, click below. I should have a link there ready to go for you where you can reserve at least a half an hour spot with one of our consultants or myself, and we can give you that action plan. Thank you and have an amazing day.